Judy's asking, after studying Fidelity's platform, trying to gain a better understanding of why sometimes a large investment bank will raise the target prices on a stock, keeping an overweighted rating, the stock price then declines some over the next few days. Is this simply to alert traders to sell or take profit before the next increase of a stock price? Shanna, why do big investment firms do this?
These analysts are in the business of looking at individual companies. So they look at publicly traded companies have to report their earnings and their financial metrics once a quarter. And so every 3 months, they have analyst calls where the management of publicly traded companies do a conference call with analysts, and they let the analysts ask questions. They go through all of the data that they release, and different analytical firms have different strategies. You have to really consider what the parameters that an analyst is looking at when you determine or judge whether their price targets are correct or not. Some of them have a very short-term focus. They look at things like technical characteristics of a stock, like if they just assume that stock price tells you everything that you need to know about a firm or about a company. So, they'll look at different chart patterns. They'll look at different parameters, technical. I won't get too deep in the weeds there, but they'll base their ratings off of those. On the other end of the spectrum, you have analysts who are strictly fundamentalist. They look at just the fundamentals of a company. They look at their earnings. They look at their sales. Are their revenues increasing? What are their margins doing? Are they controlling their expenses enough to where they have a good margin, a good difference between their income and their expenses? Are they, are they paying dividends? Are they cutting dividends? They look at all of those different things, and they have a lot of different models that they use to determine if a certain set of assumptions happens for a company, what is that going to do to their stock price over time? So because they have these 12-month targets, in 3 months, their 12-month target is going to be 3 months out of date. So now they're looking at the next 12 months. So you'll either see stock target prices moving up, or if an analyst sees that a company is struggling, maybe because their industry as a whole is having some challenges, or maybe their company as a whole is having some challenges being successful in navigating the current business environment, they will either raise or lower those prices. I don't think, now you're going to have traders who follow different analysts, and they're going to, they're going to do things based on what those stock targets end up being, but I don't think that the purpose is to alert traders. They're going to update their price targets after they look at the real things. They're going to look at, the earnings. What did the earnings do? Did they increase year over year or quarter over quarter? What has been the trend for the last several quarters? And on these analyst calls, they also give forward guidance. So they tell them, because typically whenever they're reporting their last quarter, they're already into the next quarter. And so they'll give some guidance as to what's actually happening, and then analysts can adjust their opinions up or down. So, I don't think it's really, to give traders some kind of edge. It's really just, giving the general public their opinion on what they think is going to happen in short order. So, as a long-term investor, you want to make sure you look at more of the long-term parameters rather than, and so many times those projections can be off.